It finally happened. For years, the data whispered it was coming. The geologists warned us in their technical reports, buried deep in industry journals that no one reads. The industrial analysts pointed to the depletion charts in the closed-door boardrooms of Tesla, Samsung, and Apple. But the market refused to listen. They told you it was just a commodity. They told you supply would always meet demand. They told you that if the price got high enough, the metal would magically appear from hidden vaults. They were wrong. As of this morning, the global silver supply chain hasn't just strained, it has officially snapped. The spot price of silver is hovering near $64 an ounce, an all-time high that shatters the record set back in 1980 and 2011. But here is the terrifying reality that no one on the mainstream financial news is talking about. You cannot buy silver at $62.30. You can even buy it at $64. Unless you are a Tier 1 industrial giant with a direct contract to a refinery, the metal has effectively become unobtainium at the paper price. Today, we are going to dissect exactly what just broke in the global monetary system. We are going to look at why the deficit has entered a terminal phase, why the mines are failing to respond, and why the price you see on your screen is no longer the price you pay in the real world. This is the story of the Great Silver Snap. To understand why you can't source metal today, we have to look at the hole we've been digging for the last 5 years. We are currently living through the 5th consecutive year of a structural supply deficit. This isn't a temporary glitch. It is a mathematical certainty that we have ignored for half a decade. Let's look at the numbers because the math doesn't lie. According to the World Silver Survey released by the Silver Institute, the global silver market recorded a deficit of nearly 149 million ounces in 2024. That was bad enough. But the forecast for 2025 showed another massive shortfall. When you add those numbers up, including the deficits from 2021, 2022, and 2023, we have burned through nearly 820 million ounces of above-ground reserves in just 5 years. Think about the scale of that number. 820 million ounces. That is essentially an entire year's worth of global mine production gone. We aren't mining enough silver to cover what we use. For half a decade, we have been bridging the gap by draining the vaults. We've been emptying the warehouses in London, LBMA, and New York, COMEX. But vaults, unlike mines, have a bottom. And late this year, it appears we have finally hit it. This is why the price action today is so violent. The buffer is gone. In previous years, when industrial demand spiked, manufacturers could simply lease silver from the bullion banks. But reports are surfacing today that lease rates, the cost to borrow silver, have skyrocketed to nearly 40% in some markets. Let me explain why that number is catastrophic. Under normal conditions, lease rates are less than 1%. When they spike to 40%, it is the market screaming that there is no metal available for immediate delivery. It is a smoke alarm ringing in a burning building. The snap occurred because the industrial users, the companies that need silver to build solar panels, electric vehicles, and AI servers, stopped trusting the paper market. They realized that if they waited for the COMEX to deliver, they might get settled in cash instead of metal. You can't build a solar panel with a cash settlement. You need physical silver. So they panicked. They went directly to the mines, bypassing the public exchanges entirely. This has created a two-tiered market. There's the bottom spot price you see on your trading app, currently around 64. And then there's the real price, required to actually secure physical delivery. If you try to buy an American Silver Eagle or a 100-ounce bar today, you aren't paying $62.30. You are paying premiums that reflect the reality of a broken supply chain. Let IS talk about the vacuum cleaner that is sucking up every available ounce, the green energy transition. For years, analysts predicted that as the price of silver rose, industries would thrift away from it, meaning they would use less silver per unit to save money. And they tried. But physics is stubborn. Silver is the most conductive metal on the periodic table. You cannot simply replace it with copper or aluminum without sacrificing efficiency. In 2024, industrial demand hit an all-time record of over 700 million ounces. Did it slow down this year? No, it accelerated. While there has been some thrifting in solar cells, the sheer volume of new installations has overwhelmed those savings. Solar photovoltaics, PV, are consuming massive amounts of the global supply. In 2014, solar was a niche, eating up only 11% of industrial demand. Today, that number has exploded to nearly 30%. The European Union is sprinting toward a target of 700 gigawatts of solar capacity. China is installing panels at a rate that defies logic. Each one of those panels requires silver paste to conduct the electricity. We are seeing a shift to N-type solar cells, particularly TOPCon and HGT technologies. These are more efficient than the older P-type cells, but they require significantly more silver paste, sometimes 30% to 50% more per watt. The industry is cannibalizing its own supply chain in a race for efficiency. They are trading silver ounces for electron efficiency, and right now, the silver is losing. But it's not just solar anymore. The monster under the bed is artificial intelligence. We used to think of silver demand in terms of jewelry and silverware. Those days are over. Today, silver is a technology metal. A new report highlights a sector that wasn't even on the radar a decade ago: data centers and AI. The computing power required to run AI models has driven a massive increase in IT power capacity since the year 2000. All that electricity, all those connectors, all those high-speed servers, they rely on silver's conductivity. Inside every high-performance server, silver is used in the semiconductor packaging, the solder, and the connectors. As chips get faster and hotter, the need for silver's thermal and electrical conductivity increases. You can't use cheap metals in a $30,000 NVIDIA chip. You need the best. You need silver. We are seeing a convergence of three megatrends. The electrification of the automobile, electric vehicles, EVs, use 67-79% more silver than gas cars. Every contract, every sensor, every battery management system uses silver. The solarization of the energy grid. We are rebuilding the world's power plant on the back of silver paste. The AI arms race. The desperate scramble for compute power is a desperate scramble for conductive metals. These three industries are price inelastic. That's an economic term, meaning they don't care what the price is. If a tech giant needs silver to make a flagship phone or a server blade, they will pay $60, $100, or $200 an ounce. The cost of the silver is a fraction of the device's price, but the device doesn't work without it. They must buy. And today, they are buying everything. So demand is vertical. What about supply? This is where the story turns from a market squeeze into a geological crisis. If the price of a product doubles, which silver has done, rallying from the 30s to over 64 a pelorb in the last year, basic economics tells us that supply should increase. Miners should be rushing to dig more holes, right? Wrong. Global mine production is estimated to be roughly 813 million ounces this year. Do you know what it was last year? Roughly the same. Do you see the problem? The price doubled, but production actually stayed flat. We are witnessing peak silver in real time. The easy silver is gone. The high-grade deposits have been mined out. Now we are fighting against geology, geography, and geopolitics. Mexico is the world's largest silver producer, accounting for nearly a quarter of global supply. But Mexico's output is hitting a wall. Major mines are reaching their end of life. The San Julian mine is approaching depletion. Other historic mines like Bolanitos and San Dimas are facing closure or declining grades. You have to understand, these mines have been producing for decades, sometimes centuries. The rock doesn't last forever. On top of that, labor disputes and restrictive government policies on foreign investment are strangling new exploration. The political climate in Latin America has shifted. Governments are demanding higher royalties, blocking open-pit permits, and enforcing stricter environmental laws. This scares away capital. In Peru, the second largest producer, production is also struggling due to social unrest and falling ore grades. When the grade of the ore drops, you have to crush more rock to get the same amount of metal. That costs more fuel, more water, and more time. This is the inelastic supply nightmare. It takes 10 to 15 years to take a new mine from discovery to production. You have to find the deposit, drill it, permit it, which takes years, build the infrastructure, and hire the workforce. You can just flip a switch because the price hit 64. The silver we need today should have been discovered in 2010. It was in. And now the shelves are bare. The financial markets are finally waking up to this reality. For decades, silver was treated as gold's poor cousin. But look at the gold to silver ratio. In early 2024, it was over 90. Today, it has collapsed to the 70s and 60s and is heading lower. This ratio compression is the market screaming that silver is undervalued relative to gold. But unlike gold, which is hoarded in vaults and stays there forever, silver is consumed. It is burned up in electronics, buried in landfills, and scattered across solar fields. It disappears from the investable stock. When you combine a 5-year structural deficit, record industrial demand, and stagnant mining supply, you get the explosion we are seeing today. But why specifically can't you buy at $62.30? Why is that number significant? Because that was the last resistance line. That was the line in the sand where the paper shorts, the banks and hedge funds betting against silver, tried to hold the market down. When we broke through $60 earlier this week, the algorithm snapped. The shorts were forced to cover, triggering a melt-up. However, the bullion dealers, the people who actually sell you metal, saw this coming. They stopped selling at spot. If you look at the major online dealers right now, you will see out of stock or massive premiums on physical bars. The disconnect between the digital price and the physical price has never been wider. There is one more layer to this supply shock, and it involves the miners themselves. You might think, with silver at $64, miners must be rich. And yes, their margins have expanded. The average all-in sustaining cost, AISC for miners, has dropped to around 13 per ounce in some cases, while margins have reached decade highs. At $64, they are printing money. But here's the catch. They aren't selling all of it. We are seeing reports of miners withholding supply. Why sell your silver today at $64 if you know the supply chain is broken and it could be $100 next month? This is called supply discipline, but in a panic, it looks a lot like hoarding, and it only adds fuel to the fire. The miners know what the geologists know. The new deposits aren't there. They're hoarding their own product because it is more valuable in the ground than in the bank. In Section 1, we established that the mines are tapped out and production has hit a wall. But whenever I talk about a silver shortage, the first comment is always the same. We'll just recycle it. It sounds logical, doesn't it? We have billions of iPhones, laptops, and old solar panels sitting in landfills. Surely we can just melt them down and solve the deficit. Here is the uncomfortable truth that the circular economy. Experts don't want to admit. Recycling is not a safety valve, it's a bottleneck. And right now it is failing to fill the gap. Let's start with the solar panels. We know solar is the biggest industrial consumer of silver, eating up nearly 30% of global supply. You would think that old panels would be a goldmine for recycling. They aren't. They are an economic nightmare. The silver in a solar panel is used in the form of silver paste. It is printed onto the silicon wafer in lines thinner than a human hair. To get that silver back, you have to shred the entire panel, burn off the plastics, and use harsh chemicals to separate the metal. Current traditional recycling methods recover less than 70% of the silver, and the purity is often too low to be reused in high-tech applications without expensive refining. While recycling supply has risen slightly, up about 6% in 2024 to roughly 194 million ounces. It is nowhere near enough to cover the massive industrial demand. The recycling process is expensive, dirty, and slow. But the bigger problem is time. Solar panels are built to last 25 to 30 years. The panels being installed today won't hit the recycling centers until the 2040s or 2050s. We are currently scrapping the panels from the early 2000s, when the industry was tiny. The volume of waste simply isn't there yet to make a dent in the deficit. We are waiting for a wave of scrap that is still decades away. And what about electronics? Your iPhone contains about 0.03 grams of silver. It's tiny. But when you multiply that by billions of devices, it's massive. The problem is, silver is the thrifty metal. Because it's so conductive, manufacturers use microscopic amounts. It is often cheaper to mine new silver from the ground in Mexico than to extract microscopic flecks of silver from mountains of e-waste. As a result, millions of ounces are simply thrown away every year. We are burying our wealth in landfills because the paper price of silver was too low for too long to make recycling profitable. Even with the price hitting record highs today, the infrastructure to reclaim that lost silver doesn't exist at scale yet. So if the mines are flat and recycling is a myth, where is the physical silver going? This brings us to the most critical part of the snap, the China factor. For the last decade, Western investors treated silver like a paper gambling chip. But the East treated it like a strategic resource. China is the world's largest producer of solar panels. They control over 80% of the global supply chain. To maintain that dominance, they need physical silver. And they are sucking it out of the global market at a terrifying rate. Reports indicate that China OS silver inventory at the Shanghai Futures Exchange has dropped to historic lows, levels not seen since 2015. Why? Because they aren't storing it. They are using it. They are turning silver bars into solar paste and exporting it to the world as finished panels. This creates a one-way street. Silver leaves the vaults in London, goes to China, gets manufactured into a product, and is then bolted onto a roof in Germany or California. That silver is gone from the financial system for 30 years. It has been demonetized. And it's not just China. Look at India. In 2024, India imported a record amount of silver. Some estimates put it as high as 1,600 tons. In 2025, despite the price hitting all-time highs, the Indian appetite remains voracious. The Indian buyer is smart, they buy the dip, and they buy the breakout. Reports from the ground say that Indian investors aren't selling their scrap back to the market, even with prices at record highs. They are holding. They know what's coming. This massive physical buying from the East has drained the liquidity from the West. And this brings us to the crime scene, the COMEX vaults in New York. This is the part the banks don't want you to understand. When you look at the COMEX inventory reports, you see two numbers, eligible and registered. Eligible means the silver is sitting in the vault, but it belongs to someone else, a private investor, a family office, or a bank. It is not for sale at the current price. Registered is the silver that is actually available to be delivered against a futures contract. This is the for sale bucket. For the last 2 years, we have seen a relentless bleed of silver out of the registered category. It is moving into private hands, eligible, or leaving the vault entirely. Why does this matter? Because the price of silver is determined by the paper contracts, but the delivery must come from the registered stockpile. As that stockpile shrinks, the leverage explodes. We are seeing signs that the registered stocks are dangerously thin. If a major industrial buyer, say a Tesla or a Samsung, decides they want delivery of 10 million ounces next month, the metal simply might not be there. This is why the paper price and the physical price have divorced. The paper market is pricing in a world where supply is infinite. The physical market is pricing in a world where the vaults are empty. The supply chain didn't snap because we ran out of silver on Earth. It snapped because the silver moved from for sale to not for sale. It moved from weak hands in the West to strong hands in the East. The deficit is projected to be around 117 to 149 million ounces this year. This is the 5th consecutive year of deficit. You cannot run a deficit forever. Eventually, the cupboard is bare. We are at that point. Let's go back to the supply side for a moment, because the situation in Latin America is worse than most people realize. Mexico AS production is forecast to fall due to the aging of the San Julian mine and the gradual closure of others like Bolañitos. Peru is seeing production decline due to the closure of mines like Cerro de Pasco. These aren't just statistics. These are communities, jobs, and supply lines that are shutting down. And even if the price hits $100 tomorrow, these mines cannot just reopen. It takes years to permit, dewater, and staff a closed mine. The supply response is inelastic. The demand response is inelastic. When an immovable object meets an unstoppable force, something breaks. That something is the price. So we have a broken supply chain, empty vaults, and voracious demand. What happens next? In Section 3, we are going to look at the endgame. We will discuss the price targets, the potential for a silver squeeze that makes 1980 look like a warm-up, and exactly how high this rocket can go before the physics of the market force a collapse. We are now in uncharted territory. The paper price has broken its historic shackles. The physical supply chain has snapped. The East is draining the West. This leads to the final trillion-dollar question. How high does this go? To answer that, we have to look back to the only other time silver broke the financial system, 1980. In late 1979, 2 Texas oil billionaires, the Hunt brothers, realized what we are realizing today. Silver was woefully undervalued. They started buying, not just futures contracts, but physical metal. They took delivery of over 100 million ounces, effectively cornering the global market. The price went from $6 to nearly $50 in a matter of months, an 800% increase. It only stopped because the exchanges and the Federal Reserve stepped in and changed the rules, forcing a liquidation that crashed the price. But here is the terrifying part that puts today's $64 price in perspective. That $50 peak in 1980, if you adjust it for inflation using official CPI numbers, that is equivalent to roughly $140 to $170 in today's money. Think about that. Even at $64 today, silver is still less than half of its inflation-adjusted all-time high. We aren't at the peak of a bubble. We are barely back to the starting line. The mainstream banks are finally scrambling to update their models. They spent years telling you silver would stay in the 20s. Now look at their forecasts. Bank of America is projecting silver to hit roughly $65 by 2026. UBS has raised its target to $55 to $60 by mid-2026. Even conservative analysts are admitting that the deficit is structural and will persist. These are the conservative estimates. They assume a functional market where miners can slowly ramp up production. But as we've established, the market is not functional. We are entering what analysts call an industrial supercycle. The demand from solar, EVs, and AI is not cyclical. It is structural. It is not going away. Keith Neumeyer, the CEO of First Majestic Silver, one of the world's biggest primary silver miners, has stated publicly for years that he believes silver needs to hit 100 to 130 dollars per ounce just to incentivize miners to build new mines. Why $100? Because that's the price where it becomes economical to explore for, permit, build, and operate a new mine in a world of high inflation and strict environmental regulations. Until the price hits triple digits, the supply response will be zero. So, what is the endgame? The endgame is a force majeure event on the COMEX. This is a legal term that means unforeseeable circumstances that prevent someone from fulfilling a contract. If the registered inventory on the COMEX drops too low, and we are getting dangerously close, the exchange will have no choice but to declare force majeure. They will tell contract holders who want physical delivery, "Sorry, we don't have the metal. Here's a cash settlement instead." At that exact moment, the link between the paper price and the physical price will be severed forever. The paper price might be $70, but the physical price, if you can find any, could instantly gap up to $100, $150 or more. It will be a true price discovery moment, unanchored by paper leverage. This isn't a conspiracy theory, it's market mechanics. When you sell 500 paper claims for every 1 real ounce of silver in the vault, eventually more than one person asks for their metal. Today, everyone is asking for their metal. The supply chain has snapped. The deficit is terminal. The East is draining the West. And the price you see on the screen is a mirage. If you are an industrial user like Tesla or Samsung, you are already panic buying directly from the mines, securing supply at any cost. If you are an investor, you have to ask yourself one question. Do you want to own the paper promise, or do you want to own the physical reality? Because very soon, you might not have a choice. The window to acquire physical silver at these prices is closing. Not because the price is going up, but because the metal is going away. We are living through history. The great silver snap is here.